Time for our big conversation this morning, and Dhiraj Agarwal in the studio, MD Ambit Investment Managers. Dhiraj, great to have you here and welcome
Same here. Good
to
morning.
the NDTV Profit studios. Fantastic.
Good morning. Nice to be here in such a fabulous office.
Thank you. Thank you very much.
Office is fabulous, but the day is a little shaky. Friday the 13th mood. Of course, we're not talking to you about the day's trade, but just to get your outlook of where these concerns are coming from, in your view. And do you see this spilling into 2025?
I think so, yes. So I think there is a perceptible slowdown in earnings, right? So I mean, just look at FY25. We started the year with 15% earnings growth estimate. We're likely to close the year at 8 or 9%. The earnings cuts after the September quarter season was the highest since March 2020, which was the COVID quarter, right? So there are few data points which indicates that there is a more visible slowdown, and a country and economy of our size, you can't really reverse the slowdown in 1 quarter or 2 quarters, right? I mean, it takes some time. So I think we should brace for a tougher 25.
Tougher 2025 as a whole.
That's right. Most of 25.
The belief, Dhiraj, was that the government spending has stayed slow because of, let's say, the elections and monsoons, and as it picks up, there will be a notable impact seen on growth. Then the base effect comes into play any which ways from quarter 2 2025 or quarter 1 FY26. Those factors won't aid?
No, it will. So will the subsequent 2-3 quarters be as weak as the, I mean, will we see 5.5% GDP print next 2 quarters as well? I don't think so. I think we should climb back to above 6. But will it go back to 6.7, 6.87? That'll take time. So some of the government spending which was held back will obviously come back into the market. But remember that unlike each of the previous fiscal years, this year's government's revenue collections is running broadly in line with the budgetary estimates or slightly lower. Last 2 or 3 years, the government had a fabulous advantage of if they estimated X for the revenue collection, we always collected 1.1. So there was enough cushion for the government to do more. Right now, that cushion is just not there. And the message which the Lok Sabha elections of 2024, June 2024 gave the government, and some of the state elections, the messaging which is coming from there is, you can't just focus only on structural and capex part of the economy. There is other part of the economy also which might be suffering a little bit more, and one needs to take care. So 2 factors. One is the revenue collection is, revenue growth is not as much or as buoyant as what it was in the last few years. And second, the government is little bit in the mood to do a slightly more balancing act as compared to, let's say, pre-June 24 elections, right? So both this put together, numbers will pick up from where it was in the first half, but it'll still be lower than what the estimates were and what the expectations are.
So more subsidies, more direct cash transfer schemes.
I'm not saying that.
Could be one takeaway of what you're saying. No, my only point is then your consumption play then should come back into action.
See, it won't be enough. So there are a few other structural issues, right? So finally, it looks like high inflation, high food inflation is affecting the wallet share. So there are a number of factors impacting demand slowdown. It's not just government spending. It's not just the amount of money that you pump into the economy. So commentary after commentary coming in from the management is saying the same thing, that finally the food inflation is forcing people to cut back on spending on some of the other areas, right? Second is there is a little bit of clamp down, if you want to use that word, or if you want to use slowdown or tightness in consumer credit growth as well, right? For the right reasons, because we have to balance a large systemic risk versus growth requirements. We can't keep on running growth fueled by just leverage and debt, which eventually, when the pain from that comes, it's larger, it lasts longer. Rather take some short-term pain right now. I mean, take a couple of shots and cure yourself rather than let it.
No, so okay, let's try and invert the issue. So let's assume that your base theory is that growth isn't looking great, and therefore markets may have an issue or two or a spot of bother. Valuations aren't exactly cheap.
Yeah.
What does well in such a scenario? I mean, people don't have Nifty futures in the portfolio, hopefully.
Yeah.
So therefore, let's assume the market is tepid, mildly lower, etc. But there will be outperforming themes.
Of course.
What is outperforming?
Of course.
According to you?
So, in fact, I always say that whenever we discuss Indian slowdown and people start to get very depressed, some people start to get depressed and some people start giving counter data points saying, but wo dekho, wo segment to acha kar raha hai. So my response always is slowdown for India still means a 6% GDP growth, right? It's not recession. It's that you've come down from 7 to 6, so directionally it hurts, but it's still 6 or 5.5 if you want to be really bearish or conservative. And in that range, what happens if, let's say, 1/3 of the sectors in the market is, for the sake of mathematical argument, let's say is not growing. So the growth rate is 0. To get to 6, the other 70% has to be growing at 8. I mean, simple mathematics, right? I mean, you don't need to be an analyst to do that. So you will obviously find pockets of growth. You will obviously find areas which are growing faster than the GDP growth and areas which are growing slower than the GDP growth, and a couple of areas which might decline as well. So it's not a doomsday scenario. It is just that the kind of markets that we were used to, and we were used to 2 kinds of markets in the last 3 years, right? One is it just goes up and every dip is a buying opportunity. So that is broken. Second market that we were used to in the last few months was just focus on the stories. You just don't have time to crunch the numbers, because if you take 2 weeks to crunch the numbers, the stock is already at 40%.
Has that happened to you recently?
It happened.
Any war wounds or bruises?
Many. So people like ourselves who like to do deep research, like to do channel checks before you enter into everything. You take 2 weeks to do research and say, sorry, we can't buy this anymore. Stocks are 50%. I mean, you buy first, ask questions later. Like we do in Wasipur. You shoot first and ask the name. Bhai sahab, by the way, naam kya tha inka?
So that's changed.
So that's changed, right? It's a numbers-focused market now. So the big message, big takeaway that I had from the September quarter results and August and November market reaction is that even a so-called market darling, stock will get punished if you miss the numbers. So the focus on numbers is very, very high. Analysts can breathe a sigh of relief that jobs are secure. Instagram influencers are not taking it away. So the numbers market is back. So these are my 2.
But that's a good thing.
That's a good thing.
That's a good thing if now a little bit of the euphoria is maybe behind us. Maybe the only concern there is a lot of investors are newer investors. The volume of investors that have come in, retail traders, etc., your SIP money is relatively new. They're not used to this kind of a market.
Yes.
And then what they do next becomes important.
So there are 2 categories. I mean, you talked about new investors in the market. You also mentioned SIP money in the same breath, right?
Yeah.
I would differentiate the 2. So I think SIP money is actually smart money, and SIP money is actually mature money. And talking to various friends who are just not connected with the markets, friends or family, who are like doctors in a small town in Orissa, don't understand EO of equities, but they started SIPs 5, 7, 8, 10 years ago. One takeaway, take home that I have, it's very, very anecdotal, and talking to 5 people doesn't make a whole country, but I think it's fairly representative that anybody who started SIP 5 or 7 years ago, I would say, which means you started pre-COVID, so which also means you saw the COVID crash, has learned one thing, that you should never stop an SIP. Only then the returns come, right? Because that much math anybody can do, that had I stopped my SIP during the COVID month because of the fear, my returns would have fallen short, because for those 5 or 6 months, the fact that your money went in at the bottom of the market helps your overall returns. So I think SIP is fantastic. SIP is India's 401k. It's here to stay. It might go a little bit up and down. That's stable money going into mutual funds. It'll keep rising on a structural basis. That's a fantastic part of the story. The direct retail investments, many of which are done just by focusing on the narrative story, newspaper headlines, news channel headlines, or Instagram, TikTok videos, that's at risk. because that's under-researched. SIP eventually goes to mutual funds where professional managers are working full-time. Volatility of generally of professionally managed investment products is lower than that of the riskier segment of the market, right? So that I think is here to stay. This part is, yeah, we'll see some hard ones.
So okay, I was wanting some specifics about what is it that you think could be the theme of 2025. And I also want to ask, I don't know if it's a pattern, but every time that Dhiraj is on a conversation with us, between Zomato, Swiggy and Blink and Zepto, they do something. This time around, it's the launch of Bistro. So we'll come to Bistro in a moment. But
yeah.
Specific themes, Dhiraj. We have about 3-4 minutes left. But
sure.
Things that you believe could succeed in 2025.
So I'm extremely bullish on US at this point, right? I mean, US economy, there have been recession bogeys about the US economy for the last 3 years. It ain't happening. I mean, that's economy is very, very stable. And like it or hate it, but Trump will be positive for the US, at least in the first couple of years of his presidency, which directly translates into IT sector. I think IT sector will give you some small positive surprises going forward. So that's one bright spot.
But frontline or mid-cap?
The whole sector should do well, but that's a very good question. Not just in IT, but this is one observation that across sectors, the second liners, just one below the front, are tending to grow faster. When either there's a size advantage, the base advantage, or they are willing to take more risks. Many of our frontline leaders, leader companies, managements have probably become slightly risk averse, and which is why, if we say in the last 4 or 5 years, Nifty is performing worse than BSE 500, which is worse than, let's say, Nifty Junior, and so on and so forth. The small cap is one of the best performing index. So that's a possibility, but I think everything does well. So US facing businesses. Pharmaceutical is another US focused business going through a little bit of a correction at this point of time, but I think if we take a longer term view on that, like 1 to 3 year view on that, pharma should also do well. But pharma is a heterogeneous sector, right? I mean, you can't paint everybody with a similar brush. IT is more homogeneous to some extent. So you'll have to pick and choose your stock ideas within that. Within the domestic consumption, while consumption is generally weakening, there are pockets of strength. So some parts of the durables market is still doing well, air conditioners are still doing well. Titan may not be doing so well vis-a-vis competition, but jewelry in general is doing well. Number of areas of retailing is still doing well. So there are pockets. It's difficult to find a theme in a market like this, but within each sector one can find ideas. So even in banking, banking shouldn't do very badly, even in a tough market next year, because there is valuation comfort. There is a little bit of a credit growth slowdown, but NPL issues are not that. I mean, there's no crisis kind of in it. At the margin, little bit, thoda bahut yahan wahan. You know, it's...
Okay. Interesting.
Yeah, we must get the Bistro response from you before we let you go. I mean, you're talking about consumption as a concern, discretionary spending, but that doesn't seem to impact this lot of platform companies, does it?
You know...
or is that story now overblown?
No, maybe not. Maybe there is some more runway of growth out there. But actually, that story is what is hurting the listed companies, if you actually think about it. I mean, just take one example. I mean, you said Swiggy, Zomato. So let's do the Swiggy, Zomato example. And let's take the dealing room in brokerage houses as an example, right? So dealing rooms in brokerage houses are infamous for consuming junk food every Friday. It's a custom.
Also
I mean,
newsrooms,
I worked in 2 or 3 of them, and every Friday there's always junk food. Pre-Zomato and Swiggy, the junk food on Fridays was standardized. It was pizzas, right? And because you want the food to arrive on time, the answer was also obvious. It's Domino's. When who would take the risk of ordering it from somewhere else, whether the food comes in 45 minutes or 2 hours, you don't know. Now, the delivery aggregators changed that. So earlier, every Friday it was pizzas. Now I see pizzas once in 3 months. And even once in 3 months, you would say, आज यहाँ से मंगाते हैं, आज यहाँ से मंगाते हैं, आज यहाँ से मंगाते हैं. तो डोमिनोज की बारी आते आते 6 महीने निकल जाते हैं.
Short, jubilant food works. I'm just kidding. But you drive on the point well. But
No,
yeah,
so-
sorry, just trying to square the circle.
Yeah.
Zomato, Swiggy, I mean, do you like the newish platform companies or is that?
No, I do. I mean, you have to just be a little bit cognizant of the price and the valuation set. But I think these are trends which are still not mature. At some point of time, they will be. But these are trends which are still not mature. These are trends which are still growing. People are not just getting used to sitting at home and delivering, they're getting addicted to it.
Oh.
Yeah, I mean, I order my bread online now. For a 250 rupees sourdough, I get slapped by 120 rupees delivery charges, taxes, tips or whatever. But it just become a habit now. Now you don't send somebody out to buy it. I mean, the office where I work in, there's a fantastic bakery on the floor. I just forget to pick it up from that bakery when I reach home. And when I reach home, I order from the same bakery on Swiggy and pay 150 rupees extra. It's an addiction, I'm telling you. It's not just a habit.
You know, the CEA yesterday, Chief Economic Advisor, said that junk food and on-screen time is the big addiction that the population is facing. But I mean, that's good for these companies, I suppose. Dhiraj, absolute pleasure speaking with you. Thank you so much.
Same here. Thank you.